Good morning and welcome to the latest live Bridging Commercial virtual roundtable in partnership with Market Financial Solutions. Thank you for joining us. I am your host, Beth Fisher, editor at Medianett, the publisher of both Bridging and Commercial and Development Finance Today, and also the bi-monthly print Bridging and Commercial magazine. Today, the panel and I will firstly give you our reactions to the Chancellor Rishi Sunak's budget announcement that happened earlier this month. In setting out plans to protect jobs as the UK emerges from the coronavirus crisis, Sunak confirmed the extension of the furlough scheme until the end of September. He also announced the introduction of new restart grants to help businesses reopen, especially in non-essential retail and hospitality, and also a new recovery loan scheme to help take the place of the bounce back loan scheme and CBIL schemes. He also announced the extension of the stamp duty holiday for property worth up to £500,000 until the 30th of June, with the nil rate ban then moving to £250,000 until the end of September. On top of this, he revealed the launch of the mortgage guarantee, which will offer lenders government assurance when providing 95% mortgages. I'm interested to find out what our experts today think about these two initiatives in particular and how they will impact the bridging finance market. In the second part of today's discussion, we will be delving into the latest quarterly research from MFS, which surveyed over 2,000 nationally representative UK adults, 975 of which have investments outside of their main residential property. The data looks at how property investors are potentially changing their approach to mainstream and alternative finance, and I look forward to hearing whether our panelists agree that we could see strong demand for specialist products this year. So let's hand over the conversation to our experts, who I am really excited to hear what they have to say on these two topics. I'd like to introduce our lender sponsor, MFS, and for brokers in no more than 2 minutes. Please, can you kindly introduce yourself and explain a little bit more about what you and your business does? Tiba, do you want to go first?
Hi, yes. So, hi, I'm Tiba Raja from MFS. So I'm one of the directors there. I'm basically responsible for the operational side of the business, the marketing and the communications, and assisting on any new projects that MFS are proposing to do. So yeah, that's basically what I do.
Thanks, Tiba. Imogen?
Hi, I'm Imogen Williams from MFS again. So I'm a BDM at MFS. I've got a background in broking and I've been in the industry for about 9 years. And I'm passionate about lenders and brokers working cohesively to provide bespoke, fit-for-purpose financial solutions. And that's basically what I try and do and put to the forefront of all of my relationships.
Brilliant, thanks for that, Imogen. Matthew?
So I'm Matthew Phillips from Clifton Finance, and predominantly we deal with bridging finance. So we get a lot of leads online through sort of marketing, online marketing, and we deal with clients all over the UK, from loans from 50,000 up into the millions, but predominantly, yeah, it's short-term finance and development that we deal with.
Thanks for that, Matthew. And Jason?
Thank you, Beth. Hi, I'm Jason Caprioli. I'm with Kingswood Associates. The team has been in existence since 1997, small team with 2 offices, one in London, one in Cardiff. We do everything from the regulated side all the way through to development and term debt. Yeah, thank you for having us here today. It's great to be here.
Thank you, Jason. And Nick?
Hi everyone, I'm Nick Mayhew from Peak Business Finance. We're a small team of finance brokers. We work in both the property world, doing things like bridging loans and property development. And we also work with trading businesses, helping them on the working capital side, growth, expansion, acquisitions, and kind of everything in between, really.
Great, thanks, Nick. And last but not least, Piragash.
Hi everyone, yeah, I'm Piragash. I'm the founder of Totem Finance. We were set up in 2015. and we're set up really to leverage the experience of the team to really focus on serving developers and investors, and try and keep funding as simple as we can.
Perfect, thanks for that. And then this is just for the audience. There is a chat box on your screen. There'll be a control panel on the right. And if you have any questions for our experts today throughout the discussion, please do post those. I will be looking through those throughout the discussion and putting them to our panel. We'll also have a 5 to 10 minute period at the end of the discussion to go through any of those. If we do get inundated with questions, I will, any that can't get asked, I will send them to the panel who can talk through those at the end, and we'll use that in the write-up next week. But yes, please do use that, and also you can raise your hand if you're having any issues throughout as well. Okay, so with no further ado, I'll start the panel discussion. So my first question is all about the stamp duty holiday, which has fueled the residential and bridging market. Tiva, do you think the latest extension has just extended the cliff edge?
Beth, no, I don't personally think it has extended the cliff edge. I do think it's going to taper it off. So by having the stamp duty, I think Rishi Sunak needs to put a date. Everyone needs to have a date in mind. So I think in terms of him having a date, I think the fact that he extended it was brilliant. And also there's part extension till the September. So it gives time so we can kind of taper off rather than just falling off the cliff. And by introducing the 95% loans, mortgages, I think that's kind of going to help, you know, the shock of just stopping it completely. So no, I don't think it's the cliff edge situation. I think more of a tapering off, in my opinion. So yeah.
Thanks for that, Tiva. Piragash, what impact is this having on completion timescales and pressure for all parties, in your opinion?
I think you know, the one thing I'd say is we in the bridging market and developed market, we don't operate in a bubble. You know, so we use a load of professionals, whether that's lawyers or valuers or MSs, that are impacted by the wider market. So it's definitely the case that I think you know, the mainstream lenders are overrun, and also because things like, for example, the stamp duty holiday, because it's a temporary measure, it's not like everyone's going out and resourcing. You know, we're all working in a pandemic environment, all of those types of things. So it's not like a permanent shift. However, for all that, you know, one of the things that for me is that because we are in the bridging market, I think the alternative finance space is where you find the most amount of flexibility. And I think that's what's been particularly refreshing for new borrowers who are using alternative finance for the first time. And maybe this stamp duty holiday and the need to use bridging has kind of opened up doors, if you like, for a lot of customers into this kind of space.
Thanks for that. Nick, would you agree? What's your opinion on the latest extension to the stamp duty holiday?
Yeah, I completely agree with what's been said so far, and I think it's been a breath of fresh air, because I imagine, like everyone else, we're under a lot of pressure to complete deals quickly. So are the lawyers, surveyors, all of that. So yeah, I think it's been great, that extension, to allow all those deals that maybe wouldn't have hit the original deadline to complete. So I think it's been a complete breath of fresh air.
Matthew, would you, where would you say are I guess the main stumbling blocks in the completion timescales at the moment, especially when it comes to completing before the deadline?
Absolutely, it's just mainly solicitors, to be honest with you. So because solicitors are just inundated at the moment, obviously, because, you know, they're doing it across the board with residential mortgages, buy-to-lets, commercial, also bridging. So I mean, because of the huge influx of people trying to sort of, you know, bottleneck these deals to get, in time before the holiday finishes, solicitors are completely inundated. And I mean, there are other things with the amount of sort of clients coming, for whether it's bridging short term or buy to lets, the surveyors, that also need to visit properties. But I think a lot of things that have come to light which are positives with this, with regards to lenders working with desktop valuations, etc., which are actually speeding up from a bridging finance perspective fairly significantly. So there are a lot of positives to come out of this as well.
Matthew, if I may, do you agree though that, so I completely agree that legals are getting delayed, but the one thing I think that sometimes is difficult for lenders to always comprehend is that whatever solicitor you use or whatever third-party professional, as far as the client's concerned, as far as the broker's concerned, it's all the lender. So if the solicitors are delaying things, we almost don't want the excuse of it's the solicitors, because as far as the client's concerned, it is the lender. And I think the engagement of the solicitor and the valuer really early and making sure their control has to rest, because as brokers, I'm sure we all agree, we're constantly phoning up going, well, are you going to be there? Where's the report? You said it was going to be there in 3 days and it's not there yet. We've got a client who's desperate to kind of get a deal done, but really we hold very little power. The client holds very little power. The person that is really in control, who's actually paying the third-party professionals, is the lender, and I can't get it across kind of hard enough, is that it's so important for lenders to realize that it's their reputation. When a solicitor or valuer doesn't quite deliver, it's not actually the valuer or the solicitor, it's the lender that gets, their brand gets impacted.
Yeah, absolutely. It does feed back to the lenders, isn't it? And I think with a lot of the lenders we deal with, I think their solicitors or surveyors are working with them, or definitely doing their utmost to work with them to adhere to these timescales. A lot of the stuff we do is regulated, whereby it could be a client have dealt with a solicitor firm their whole lives, and therefore they will opt to use that solicitor. So I think it's what we've realised recently is educating the client to first of all have a solicitor that deals or has. Well, we ask the question: have they dealt with bridging finance at all? Might be no, and therefore that's a big cross. And then it's a case that have they been instructed to carry out searches or whatever on this property? And again, if that's a no, then we don't advise who they use, but we can make recommendations. And I think that is a huge impact on timescales at the moment, whereby it could be a case that could have taken 6 months to a case that can now be done in 6 weeks. So yeah, I think lenders at the moment they do have good offerings with their solicitors, and sometimes they even let you pick off their panel. But yeah, it's educating the client as to what solicitor to use. Yeah.
Imogen, just kind of following on from what Piragash and Matthew said there, how do you as a lender kind of manage those hurdles to timescales, just to ensure that your brand is protected?
Yeah. So definitely for us, what we try and do, so before we do anything, when we issue credit back terms, we've essentially underwritten the deal. So at the point where the client is paying their fees and ready to go to application, that's when we're engaging the third parties. So that's at the start of the deal. So to combat that, that's what we do. We engage all the third parties at the start of the deal, so that through the underwriting process, those parties can continue, they can work on the deal. And that's essentially what we do in order to sort of expedite the process. And although it may be we may be asking for a little bit more information up front, it does expedite the process massively when all the third parties are engaged at the very start of the process, which I think is something that Piragash was saying, is that's when they should be engaged.
Sure. Moving on to the other big announcement that happened in the budget earlier this month, which was all about the 95% mortgage guarantee, which is expected to improve the resale market for property investors flipping properties, and also for the second stepper segment of the housing market. Jason, what impact do you expect the 95% mortgage guarantee to have on the bridging market in particular?
So I think just taking a step back slightly, any stimulus, so with the stamp duty extension, is really positive. And yeah, lobbying to have it extended again from September. I'm not sure how popular that will be, me saying that, but I'm massively in favour of lower taxation environment and stimulating growth in that way. Talking about the 95% mortgages, it's really exciting. We saw with the Help to Buy, and Piragash will probably attest to this with the development clients that he looks after. The Help to Buy massively supported these lower value properties in terms of achieving higher valuation numbers when you compare to sort of the second-hand product. And this 95% support is just going to be that step that allows people to trade and move through, and actually maybe helps with, in terms of the bridging side, helps with the developers that aren't taking something ground up and building brand new, but are doing what's very, I don't know if this is the sort of right phrase to use, but the tart and turn approach to property development, it could be a massive help. So yeah, I'm excited to see how it plays out once the lenders have got their head around it, and you sort of see it filtering through.
Matthew, do you expect that this mortgage guarantee scheme will give bridging lenders a bit more, I guess, confidence because of the exit options which it could present to the market?
Yeah, absolutely. I mean, it's just another string to the bow, really, whereby so that obviously it's 95%, isn't it, that they'll sort of go up to, and they'll sort of supplement any sort of room for defaults. Obviously that's the worst case scenario, but it means that, you know, you're not going to have people, you know, have less clients defaulting and having properties repossessed, etc., and run into a volatile sort of market. So I mean, yes, with bridging finance, a lot of the time for investors, I imagine they're purchasing a property, and bridging finance LTVs aren't, you know, they're not massive these days. You're looking at probably 70-75% on average at a sort of top end. So I mean, when people are going in and carrying out renovations, you should see an uplift in that value anyway. But so the mortgage level, you know, should only be maybe 60% to cover off what that bridge was of the end value. However, the fact that that the 95% scheme is coming in place will only prove sort of comfort into sort of bridging lenders and be helpful with repayment strategies. 100%. Yeah.
Imogen, does this impact on MFS's appetite for bridging?
I think it's always useful to know that there's a sort of increased market for it. It creates a certain more element of certainty around exits. Certainly, there's going to be more people in the market for our investors should their exit be sale. It certainly provides a bigger comfort in that way. I would hope as well that it would stimulate competition within, I think, particularly in the first and second time buyer market. It will stimulate competition, which hopefully will have a positive effect on house prices, all of which will feed into MFS's appetite in the market for bridging. I think we've got a pretty big appetite for it at the moment as it is, but you know, more people in the market providing sale exits is always good, and potentially you know, bolstering house prices is always good.
I think the other question I'd love to know what the other panelists sort of think is, you know, Help to Buy was really an equity-led kind of solution, which meant that the affordability also was much easier, and that's where, you know, we've seen house price growth and valuations go up. The 95% guarantee scheme is largely debt-led, and I wonder whether, you know, it would have been better, for example, you know, I mean, on one hand, personally, just to have a different view, I think that maybe this is, of all the things that, look, Rishi is amazing and no one can say anything bad about him because he's rescued all of us, but I think this particular piece is probably the most gimmicky out of everything. I think when you look at the historical because this scheme sort of existed previously and it wasn't really used very much. And I would have much rather seen kind of Help to Buy expanded, but actually maybe allowing private companies to kind of enter and start putting equity in to allow people to afford things going forward. Just interested to see what other people might think about that.
Yeah, I think affordability for the 95% will be particularly tough in London, especially on single income households. So yeah, I think the take up will be more for Help to Buy in that area. So yeah, I would agree to a certain extent.
It depends though, right? Because we've got lower interest rates than ever before. So if you look at, you know, the 4.5 general rule of thumb, right? You can borrow 4.5 times your income for your primary res approach. When you're looking at being able to fix a rate at under 2% for 10 years, you think, right, well, could I actually afford to borrow a lot more? And you know, it's a question of, do we need to look at the whole piece now? Do we need to look at whether 4.5 times is appropriate? I know that obviously you don't want to create massive house growth inflation, because it didn't necessarily help previously, but if you've got people on good incomes and they can't afford to trade up, then there's a fundamental mismatch in the market, perhaps.
I think, yeah, sorry, I think Jason's got a good point about the base rate being like 0.1%. When we had 95% mortgages before, there was a risk of negative equity, and at that time interest rates were high as well. So then it was even, you know, that when the market did crash, there was a lot of negative equity and there were problems. But I think in this case, because the interest rates are pretty low, people can afford to, and the opportunity cost of putting down 5% rather than 30%, obviously there's going to be more investors in the market buying more, so you've got these second steppers, as Beth was saying. So I think in this situation, I think he probably chose that because the base rate is so low.
I find it an interesting question from the audience, just on the stamp duty question, which we started the conversation off with. If clients buy using a bridging loan to avoid the stamp duty deadline, wouldn't that mean that properties with some lenders, wouldn't that mean that they would have to wait 6 months after the purchase, as this would be classed as a one-day remortgage?
I think what we've seen is a lot of specialist mortgage lenders who don't buy into that 6-month restriction, and thankfully, you know, a pragmatic approach and a sensible approach. The biggest challenge on the bridge to then hit the deadline and move on is the cost of the bridge, whether that outweighs the cost of the stamp that you would have otherwise paid. So it's just a case of having a good broker going through all the calculations, isn't it, and actually working out if there's a real value there for going through that process.
Yeah.
Sorry, go on, Nick.
Okay. Yeah, I think that 6-month ruling would probably, it would be a bit of a struggle to overcome, whereby it's just, you know, because of the stamp duty. I think most lenders that you would approach for a refinance within that period would ask the fundamental question as to what works have been carried out with that property to increase the value. So it wouldn't just be a case that, look, we've managed to get it cheaper than we anticipated because we paid less tax. So it would be, I think that 6-month rule would definitely be implemented. Yeah.
Would you agree though that potentially sometimes it does actually take, you know, 3 to 6 months to arrange a term mortgage with certain lenders anyway? Just a thought.
Yeah, no, it definitely does. Yeah, I mean, with long-term mortgage providers, especially in this climate, it can take at least 3 months in some instances. So I mean, a lot of people need to go down that bridging route to get it done, and therefore save. You know, depending on the value of that property is significant either way. The amount of money they're saving from the stamp duty, but
I mean, the thing that I get from what you guys are saying is that you can't wing it. You know, you can't just go buy a property, beat the stamp duty, and then go, shall I now? I'm going to now get the secure loan, etc. You know, it's like you've got to you know, for a lot of our investors that we deal with, certainly, you know, they do this as a profession, and so it's the thought that they have to go through, that they'll have to consider the tax, they'll have to consider the accounting, they'll have to speak to their broker. It may be a bridging broker and a term broker, so that really the full plan is considered. And also what I would say is, just because you have one available exit, I mean, I'm sure MFS completely agree with this, but if you just have one available exit, that doesn't mean you've got an exit, because what if that lender drops out of the market, etc. You know, so for yourself, it's how many. If you've got 5, 6, 7, okay, well now that starts to mean that you've got a real exit. So I think the 6-month question, I think the first thing as an investor is the deal profitable, whatever happens, right? Everything else is a bonus, is maybe the way to approach it.
Out of interest, how often are exits for your bridging clients falling through at the moment, and kind of how many backups do they need to have at this point in time?
I think it depends on
to answer.
Yeah, depends on the underlying real estate, I suppose. I mean, everybody knows that retail's been massively tough. So sort of getting those exits onto term debts, depending on how long that bridge has been in place, is a challenge. That being said, the housing, you know, resi housing is super strong, right? So we're seeing lots of opportunities to exit with a myriad of different providers. So standard thing that we all get as brokers, you know, what's your best rate? It's very much, well, what's the circumstance and what's the situation behind the sponsor, to be able to give a good answer on that. But yeah, I mean, Nick, you must see some interesting things, right, with the sort of stuff that you're doing on the business side and cash flowing piece that ties into this question of the retail asset class versus, you know, warehousing or massive buy-to-let portfolio, etc., etc.
So I didn't understand your question.
You must be seeing some interesting, with your business focus, not just on lending against bricks and mortar, but also the underlying business with, you know, with cash that's generated from their business activities. You must be seeing some interesting things in that space, that part of the market.
Yeah, for sure, but I'm not seeing a lot in the commercial property side at the moment. I saw quite a bit last year, particularly mid-COVID, where people were looking to sort of release cash against commercial property. But yeah, I can't really comment right now, because most of my stuff on the commercial property side is quite straightforward. So it's just commercial mortgages, and they just seem to be going through like nothing ever happened. They've been going through quite easily. So yeah,
can I have some of your clients, Nick? Can I have some of your clients, please?
It's a great car. I've got some more quirky stuff, but it would be quirky regardless of COVID, so and tricky anyway. So yeah, you can have those if you want.
Tiba, from a property perspective, what announcements were you most surprised by in the budget, and what areas do you think were lacking?
In terms of the property, I think I wasn't surprised about the stamp duty. I think everyone kind of expected that. What I found was quite surprising was his £1 billion investment in those undeveloped towns and cities to boost all those areas, because obviously that is going to have a great impact on property prices and values, and all these regeneration projects. I wasn't expecting all of that, and especially towards the north as well, because of this, I guess we have this north and south divide, and partly that was responsible maybe towards the Brexit situation. So I think he kind of addressed that indirectly. So I was a little bit surprised about that. So yeah, but what I thought he could have done, potentially, I think in terms of supply and demand of housing, obviously we've got this stimulus going, 95% stamp duty, first time buyers. But where are all these houses going to come from? They've got to come from somewhere. Someone's got to build them. Someone's got to create that space. There's all that planning and all this that goes behind it. He kind of didn't touch that area, in my opinion. And I think it would have been nice if he could have addressed that side of the property cycle as such. So more for the supply side, I thought potentially he could have done something, or, you know, but he did the other side, but maybe not, the supply, basically. Yeah.
I would agree. I did a little bit of research on the reactions to the budget, and there was a lot of people that came out and said that he should have gone, should have done more for development. And obviously development's a great feeder into short-term and long-term finance as well. So it benefits all of our industries. That's the reaction that I saw, is that he should have done more for developers, essentially. And I don't know if you guys agree. Jason, I know you deal a lot with development finance. I don't know if you agree with that.
Yeah, well, I think what you've got at the moment is, if you've got a building, you can stick another 2 stories on it, depending on, depending on lots of different things, but without too many hurdles. And we've seen a number of clients seeing it as a massive windfall, that ease of process to be able to do that. It's always very difficult because it's so complex, isn't it? Just to say, right, well, just go and build wherever you want, whatever you want, because there's a much bigger plan. In terms of the bridging side, I suppose what it does do is just mean that it's even harder for you guys when you're doing your big bridges at MSF to really understand how quickly something may or may not be approved, because there's been no clarity in that space. Where something should take 3 months, for example, especially with lockdown, people working from home, having to homeschool, all of those things has meant that there seems to be no timescales, and it seems to be really hard to get hold of people working in local government beyond 5 o'clock, and certainly you're not going to be able to get hold of them at the weekend, which has meant that this is really hard. Piragash is enjoying that statement, but it's exciting for those just PD type situations. So I think all of us will see clients that come forward and say, oh, I didn't realize, but I've got the ability to stick another 2 stories on here, and maybe it's a bridge product where we can do something in the airspace and take their residual land value as that airspace, and you can fund 100% of it, and the clients will be super happy, and then put it onto some term debt. So
the term sheet for that as well.
We'll think about it.
New product for us.
I think what's really interesting, actually, going on to what kind of Jason and Tibber said, is that one of the things that surprised me was the 150 million. We had all these macro kind of shock and awe, billions and billions everywhere, and then we had this 150 million kind of community amount for the kind of re-establishment of pubs. And I think it shows a nod towards kind of micro solutions, but also, we deal with a lot of kind of SMEs, right? And I think they have a lot of entrepreneurial spirit, and it's giving them the power to go out and build and refurbish and challenge some of the big boys. And I think to Jason's point, if you're going to spend 150 million on that, I think the planning departments, the housing minister, I guess, will be in charge of a lot of the planning policy, etc. But it would be interesting for the chancellor to say, we're trying to make developments happen. We get that there's a clog in planning, but councils, we're going to help you out. We're going to actually give you 200 million to source people, because we've got a load of unemployed people here, or we've got a load of Kickstart people that we'd love to connect it. So I think there's a lot of detail to come, but I think the final piece, for me on this is, no one's going to remember this budget. No one is going to remember it. The big, almost 2 trillion, I think it's either 1 or 2 trillion pounds worth of debt. The big budgets are going to be in 18 months time, or maybe 12 months time, and the impact that's going to have, that's going to be the ones that is really going to affect us for generations. And I think it's really important as a property community that we've got to start, pitching our corner and talking about why we need so much support, because we're going to be the ones that actually can instigate tax receipts in the future and actually make changes.
I mean, this is one of the reasons that I'm such a massive advocate to getting on the soapbox for a lower stamp duty, because if you reduce that stamp duty and instead they go out to the high street and go and buy a load of new stuff for their new house, that's going to be much better for everyone. So, you know, Rishi, if you're listening, please take that on board. So the other idea, if we're putting crazy ideas out there, is around actually, would you as a developer be happy to pay a premium to get a premium service through planning? So would you be happy as a developer to pay a much higher amount to go through a planning process in a defined period of time? And I think the answer that we receive from our clients is absolutely yes. It'd be money well spent. So just in terms of brainstorming ideas, that would be that would be maybe one to put in the pot.
Out of interest, are your clients SME developers? Are they smaller developers?
Yeah, definitely in the entrepreneurial space, which is brilliant. So so what you see is a real desire to produce value, but without having the ability to raise money at sort of the super cheap rates that the listed builders can. So they really have to work hard to make things work, which is great, because you see some real creativity when that kind of pressure is put on to the developer.
Obviously, you know, costs and costs are going up for labour and materials, and there's a lot of pressure on margins at the moment. So I find that quite interesting that they would be, you know, SME developers would be interested in paying a premium for that. In the long run, I know we're going into development here, but in the long run, would paying for that planning kind of expertise benefit in terms of costs in the long run?
Yeah, I mean, Imogen might be happy to hear this, but it reduces your cost of finance. Right? One of the biggest issues is not about necessarily the cost of materials or the cost of labour. Is one of the big considerations in development is finance cost, like one of the biggest. So your main levers are expertise in planning, expertise in finance, and then the rest of the stuff is more commoditized and generic. I would put it out there and say.
I think also ultimately it's about certainty. You know, debt is about certainty. You want to know what your exits are. You want to know when your recurring income is. You want to know what your costs are. And so, you know, following on from what Jason's saying, if you can know precisely how long something will be, it might be binary, yes or no, but that certainty will not only provide confidence for the existing lenders, but it may also widen the pool of the available lenders in the market, because new ones will come in, because suddenly development is seen as slightly less risky, or perhaps funding something on a bridge, to go back to bridging, to fund something, you know, land without planning or land with outline planning suddenly becomes more palatable, purely because we've got the certainty. And with more certainty, you get more innovation. You know, there are insurance companies in the market that are looking at kind of backing deals where, you know, potentially there's a rebate of funds if planning doesn't go ahead. Now, that only comes in when there's certainty of funding. Certainty of planning.
I just want to quickly check. Can you guys hear me okay? Just, I think my audio went in and out. Is that okay? Brilliant.
Yeah, it's better. It did go for a minute, but it's fine now, yeah.
Thank you, thank you. Okay, so moving on to the second part of today's discussion, MFS has been commissioning quarterly and quite timely research to help offer up clearer view on the property investment market. Its latest independent survey, which was of 975 UK investors, all of whom have investment portfolios valued at £10,000 and above, found that 34% of investors changed the qualities they now look for in a lender as a result of the pandemic. Matthew, what do you think are the top 3 qualities investors are looking for in bridging lenders, and why?
I'd say one is certainty, that lender, you know, once they give a decision, will not change the goal. I think another one would be communication. That's quite a big factor throughout the whole process. Obviously, people are trying to get things done fairly quickly these days for obvious reasons. So they need responses as and when required, really. Flexibility is a huge one. I was going to run one as a list as long as my arm. I've just realised I've already named you 3, but flexibility would be one. So working with them with, if they've got some manoeuvrability with rates and term and things like that. So that, there aren't any clients out there now that want to be, have that 12-month term and say at the end of that 12 months, that's it. You owe us this much and that is it now. So they want flexibility to know that they have either an option to extend a fairly reasonable, maybe the same rate and a smaller sort of arrangement fee. But they at least just want that flexibility to have that comfort of mind, especially in this climate, because we've had numerous people, even with large-scale developments or small light refurbishments, whereby they have struggled for whatever reason. They might not have actually been able to visit the property because they can't leave the house, or they're struggling to get materials. And therefore, that 12-month term that they initially took out, which they thought was going to be ample time, has turned out to be they've got a month left to do it after all these lockdowns, and they need that lender to work with them. Otherwise, they're just not going to get the job done, and they're going to be completely out of pocket. So I think flexibility is a huge one. Yeah.
And we've seen that with things like rental incomes in London, where clients have got big portfolios, and suddenly occupancy has gone from consistently being 95% to being way down, especially if it's short-term lets, and not being able to engage with lenders and just have an open dialogue around how your interests are aligned, and putting a solution in place is a real issue. And it's one of the reasons that I think brokers are so important, because we speak to these guys every single day, and you as a borrower, you might speak to them at the beginning and then at an annual review point maybe, but because we've got that regular engagement, we can just step in and help, really. So yeah, open dialogue so key.
Nick, oh sorry, no, you go ahead, Tiva.
Yeah, no, I've just, those points, the USPs, basically, I think flexibility is good, but I do think you need to make sure, like during the pandemic, it wasn't just flexibility that's got specialist finance through. It was the fact that you, and the rates, everyone has similar rates. I don't even think the price is an issue. It was basically delivering. So I find that you have to be reliable. So, we do our underwriting like top heavy at the front. So, and we can basically tell people like, we're not going to do it. We're quite happy to say no. But I do believe, and this is something we've learned over the last year, that a lot of lenders will say yes. And because they want to do it, they have the flexibility, but along the way, they kind of slightly change the goalposts, or they don't have the actual money that they think they have, for some reason. And during the pandemic, a lot of investors withdrew from the market, or they froze, or paused. So I think it's important to have people that are reliable, do know what they're doing, and understand the bridging market pretty well. So I think knowledge is quite important too, and experience. So yeah.
I go on from that as well and say that with us also, quite often things happen in legals and valuation. We do our underwriting up front, so when we agree a deal, we very rarely turn back on it. But having 8 funding lines means that, if something happens in the val or in the legals, we can often sort of get it funded because we've got a flexibility of funding. And if you have lenders that are very much tied to their covenant, it means that they aren't able to have the sort of same flexibility that we can. So it does really depend on the lender in terms of how flexible they can be. But it is a big thing at the moment, because I think all that COVID's done, the pandemic, has just increased the complexity of cases and sort of increased the complexity of everyone's situation. So yeah.
I think the one thing I would say, I think the one thing I would say is that in the specialists, because often what we do is quite bespoke, and complex. You know, de facto, your traditional lender won't look at this. And you know, one of the challenges we face as advisors, as brokers, is to kind of let a client know that there may be a lender that's not obviously the cheapest, but actually is the one that we can give most surety to that they will actually complete. And I think this speaks to the culture and values of the lender. And it's something that gets bandied around in kind of corporate speak. But I think it's really important when we talk about specialist finance, because often, you know, because we can't guess every single, as much as possible, we try and get the risks up front. But even after the underwriting process, as Imogen said, there'll be something that pops up. And the culture and the value of the lender, and actually together, you know, the funding lines potentially will impact whether you move ahead, because problems will happen. And I think that's something that's quite unique in terms of its importance, but also the challenge that we face as advisors in saying to clients, yeah, this isn't something that you would, you know, you can see a database and it says, for example, MFS, 100% of the time it will always deliver what it says. It's something that you've got to kind of trust us a little bit on. And that's a unique challenge, I think, in this space.
Yeah.
Another stat from the MFS research was that some 65% of investors fear that the pandemic has made banks over-reliant on technology when providing customer services. Considering we have seen an influx of tech and automation in the bridging market, do you think the same thing could happen here? And would it be a bad thing?
I think it could happen, but what I would say is no one complains about the amount of technology that Amazon uses. No one does. Because why? Because the customer is at the heart of it. I think technology for technology's sake is, you know, and I read the MFS report actually, and something that Tibber certainly commented on was that it's got to be customer centric. It's got to make sense for the broker, and it's got to make sense for the client. Absolutely. You know, often as brokers, not to get the violin out, but you know, we're often the hamster wheel that's taking all of the things together and putting it all together, and it doesn't matter how much admin that we have. But we're a customer too, and I think if you can make something customer centric, we should have, you know, technology is not going to go away, absolutely not. But placing it at the heart of the customer, I think, is critical.
Yeah, I agree. Sorry, you go. I think the issue that's happened in banking is that banking is hundreds of years old. They've got systems, they've got legacy systems, which they don't quite properly talk to each other. So the tech that a lot of the banks have built haven't really served the customers or the banks. It's just this swath of mess and data, which is just confusing for everyone involved. And with technology, there's this big question of product market fit. And so I think bridging lenders, typically they're normally newer lenders run by younger, sort of more tech-oriented people. They have a better opportunity to build technology that actually works, because again, there's no one's complaining about the amount of tech that Amazon uses, but banks, I won't name banks, but banks frequently roll out technological products which don't work. They're painful for everyone involved. They don't lend when they say they're going to lend, and can't quite underwrite to the levels they're going to underwrite, and then they end up sort of shelving them, but they just try and pretend it never happened. So yeah, I think as long as bridging lenders are aware and keeping the broker and the ultimately the borrower at the centre of the tech they're trying to build, you know, over relying on tech could only be a good thing.
Yeah, I agree. I mean, I think it completely expedites the process. There are small things whereby, you know, at every stage of the process, you might have to sign an application form. You'll have to sign an offer, maybe even a mortgage deed, and maybe even a few other documents, whereby the front end of it needs to be streamlined a little bit more, where they have the option to, you know, e-sign things. When it comes to maybe the more sort of formal documentation, maybe the mortgage deed, okay, yeah, that's fine. We understand there's a wet signature required on these things, but it shouldn't be every step of the way, where some lenders are saying they have to be wet signatures every stage of the way. Things like that do make a difference. To, you know, a webinar about it, they'll say, okay, if it has to be done, it has to be done. But for some of them, it can be a pain. It can be a pain. Some people don't have these, you know, for instance, a printer in a study. They have to go out the house and do it. And in this climate, obviously, people are trying to go out the house as little as possible. But yeah, and then obviously electronic identification checks, things like that. It costs a lot for these companies. Everyone understands it costs a lot for the companies to implement these and put these in place and get the correct. You know, you might have to create an app that you're sending to a client, and they're following that. But that is the way the world works these days. And like Amazon's a great example. Like everyone absolutely loves using Amazon because it's so swift. And if you have that swift approach, you're ordering something, next thing you know, so you sit at the door the next morning. Those are sort of, you know, they don't want to have these complexities along the way. They want it to be as swift as possible. And these things, you know, not having to go and find someone to certify your ID, and having the ability to do it over a Zoom call maybe, or the ability to, you know, receive that app and e-sign and show documents via your phone. It speeds the process up massively. I mean, there are some clients out there that still require the old school way. You know, we deal with clients that may be in their 80s, 90s even. So it is slightly different. You have to tailor your approach, but to have that option there in the first instance is massively sort of a positive effect on the market. Yeah.
I think the other thing is the size of the opportunity is huge. I mean, you look at the fintech space, you know, Stripe, Revolut, you know, what have they done? They've taken one part of the banking process, be it payments or FX, and they've done it really well with technology. And now they're billion-dollar companies, multi-billion-dollar companies. And I think that is the size of the opportunity in the lending space. You know, there isn't a lender yet that has, you know, that has done the equivalent in the mortgage space or the bridging space or the alternative space. And I think, you know, we're so used to technology now that I think if it can be done well, the size of the opportunity for the lenders is huge.
Yeah, agreed.
From a broker perspective, from all of you on the panel, well, what has there been anything tech-wise, piece of tech over the last 12 months which you've been really impressed with?
So in terms of MFS, like you've built in a new CRM system, implemented obviously because of the pandemic, e-sign and getting verification IDs over Zoom and everything. So a combination of that has helped us over the pandemic. I think it kind of streamlines everything, so things can move a little bit faster. And obviously with technology, you get data. So you can actually see the data, where your customers are coming from, what's driving them to come to you, at what stages, you know, they're at, and how better we can improve our services to our brokers and to our direct borrowers. So I think in terms of technology, it's brilliant, but obviously nothing replaces a human being, I don't think. So I don't know how much of you all are fed up of Zoom and you want to go out and want to meet people and do business, you know, over lunch or dinner, but I think people are getting a little bit fed up of just sitting behind a screen. So I think there has to be a balance at the end of the day.
Yeah, I think as well with us, we are tech driven more internally. So we're driven we're driven by tech internally, but externally, broker and client facing, the broker and the client only really speak to two people. That's the BDM and the underwriter, and they get all their information and everything is processed through those two people. And then internally, we use our tech to make the lives of our employees and make the process quicker. But you deal with people. So I think instead of having tricky interfaces and things like that, you use tech internally can make a swifter process rather than sort of it being necessarily client facing. I don't know if you understand what I'm coming from, but yeah, I think that can help as well. It doesn't necessarily have to be client facing tech. You can use it internally to expedite your processes while still having a very personable touch.
I think one of the challenges for us is, well, you know, for us, Totem anyway, we're a tiny micro business, and when it comes to technology, you know, you can spend and spend and spend. So has already been identified. There's some interesting ID verification. There's some interesting AML tools. There's some interesting APIs from Experian and Equifax. All these kinds of things. One of the issues though is that we're right at the gold rush. We're right at the inception of a lot of these ideas. And for a small business, it's often tough for us to kind of pick, we're going to go with this, we're going to invest in this, because obviously, and then the question is what if the lender doesn't particularly like, or 3 lenders love this system, but 15 others don't like that system. And it's not just the individual pieces of tech, which is very, very interesting. Even things like open banking is great, but some people like certain systems, some people like others. And the challenge for us is getting to that end-to-end process so it all works, rather than us again hamster wheel, picking all the 6 or 7 different technologies. I mean, I love technology, but I don't have enough bigger wallet to spend on all the different solutions.
Yeah, I completely agree, because I had that same issue a couple of years ago. So I wanted to, on the commercial side, I wanted to incorporate getting statements via open banking, tapping into cloud accounting APIs to pull in financial data to make a more streamlined transition. So there's, the client just pushes a button, they don't get document fatigue. But I was stuck because the lenders wouldn't accept any of the data that I would get, because it wasn't in their it was in a certain proprietary format rather than the kind of cover page of a bank statement. So until the lenders get on board with all the technological changes, we're kind of limited as to what we can do as brokers in embracing those tech changes. But from a lending perspective, I agree with what Imogen was saying, that a lot of the automation is good when it's done sort of on the non-customer facing side on the back end, so that you use it to facilitate, so that one kind of human, they're able to do sort of 5 times the work that they could normally, but then they could go and present a good front end to the customer and offer them a really good service and a really good personable service, and then translate that and then put it into their back end kind of software, how it works in their back office.
Yeah, I agree with that. It's kind of internally, I guess it's creating an engine to push things through a lot, whereas you're still having the personal approach with the client, with the front of it. So yeah, I do feel though that the client should have an option. If, for instance, they prefer not to meet in person, they prefer not to do these things, and they just want to sort of, have a nice swift process. And if they do pass, AML checks, ID checks, then they do have the option to just get it through from, in 3-4 days, rather than having to wait for a representative to visit them or something like that. I believe it is up to the client, subject to them meeting the bank's criteria or the lender's criteria.
The last piece of data from the survey was that 61% of investors felt they lacked sufficient knowledge of alternative finance products to consider using them. Jason, are you surprised by how many don't have enough knowledge?
I think it's hard to keep abreast of everything that is going on in the market at the moment, because there's just so much innovation, there's so much changing because of the way in which we're working at the moment, and it doesn't surprise me that it's such a high proportion. One of the nice things again about having a broker is that they can take you through that and explain, the options available to you and the pros and cons. And as has been talked about on this call, it's not just about price. There is deliverability, the amount of time, the amount of work that goes into getting something over the line that might mean as a client you want to go down more expensive routes. So I think in answer to your question, it doesn't surprise me, but it does highlight the importance of a good broker.
What surprised me about this research is that from the investors who had a portfolio of 1 mil plus, it was 70% of them that agreed that they lack sufficient knowledge. Would you say that's because, not necessarily because their brokers aren't educating them, but because they have a broker, they don't necessarily feel that, they rely on their broker to keep abreast of said financial situations, and therefore feel that they don't necessarily retain the knowledge themselves? I just found that interesting. It was the clients with the larger portfolios And I tend to feel that clients with larger portfolios tend to have brokers themselves. I don't know if you guys would agree.
I think.
Or it's the.
Sorry, go.
I was just going to say, or it's an observation, right? The bigger you are, the more you realise how much you don't know.
Yeah.
Maybe just a. Sorry.
I think also at the end of the day, if you've got a large portfolio, typically, and I'm making a huge generalisation here, but you maybe have more equity to start with. You maybe historically funded your portfolio, you know, in the 90s, in the 80s, in the 2000s. So you know, you've not had to street fight, as I would call it. You've not had to find innovative solutions. But for me, the overarching theme is, you know, as an industry, we've got to win hearts and minds. You know, there are some amazing, amazing, innovative things that lenders like MFS do that we've got to shout at from the rooftops, because they unlock stuff. You know, I can't get over how much that, you know, there are a bunch of property millionaires, investors, developers who would never have got stuff off the ground if it wasn't for the alternative finance space. And it's not about cost, because nobody here, we're all professionals here, nobody will be telling people to spend 12% a year on a product that gives them a 5% return. That's not what this industry is about. This industry is about unlocking stuff that actually means that people have a route, and finally they can engage in a project that maybe they couldn't have done before. But more importantly, they can get access to really profitable stuff. And that's the heart and minds bit. And that's the bit that we've got to, as an industry, I think that's our responsibility to really inform mainstream brokers, inform the high street that, look, there's this industry here that can definitely support, definitely be the interim until the mainstream lenders come in.
We have, we're at 2 minutes past 12, so I'm going to have to start wrapping up today's session. Unfortunately, I do have a question from the audience about needing a little bit more time in flipping properties, and whether or not bridging lenders will be a bit more lenient with deadlines on loan terms. But I'll pose that question to you guys after the discussion, and I'll include it in our write-up next week, just so that can get answered. But I know that people really need to move on with other things for their day today. So I will stop the conversation now and end the questions there. But I just want to thank you to our amazing sponsor MFS, and also thanks to our fantastic panel for taking time out of your busy schedules to be here, and for you guys, for our audience, for joining us. We'll be publishing this roundtable in full next week on B&C, as I've mentioned, and for those that weren't able to make today's live event, and also if you just fancy replaying anything that you might have missed. If you enjoyed this one, make sure you attend our next virtual roundtable on Tuesday, the 30th of March, where we will be discussing how to maximise investor opportunities from the boom in staycations. We are hosting events almost every week this year, so if you would like to sponsor one, make sure you drop me an email at beth@medianett.co.uk. Spaces are booked up until the beginning of July, so do get in touch if you are interested. And also, if you would like even more insight and news on the specialist finance sector, please feel free to subscribe for free to the Bridging and Commercial magazine. Our next one is out on the 15th of April. Have a fantastic afternoon and rest of the week, and we look forward to welcoming you to our next event. Thank you so much.